You're looking at that soft ADP report and, of course, just headlines. I mean, tech alone, more than 30,000 layoffs. Ahead of the jobs report, what are your expectations and what do you think this could mean for the Fed, despite what we heard from Jay Powell earlier this week?
Yeah, I mean, for the ADP report, it's not necessarily predictive of BLS, but I do think you're going to continue to see a cooling of the labor market, or really a normalization of the labor market. You see that in the JOLTS data as well. Things just kind of returning to normal, and maybe what you would expect for a higher interest rate environment. So, ultimately, what the Fed had said and what Chair Powell had said spooked equity markets a little bit, but ultimately didn't change how many rate cuts in 2024 that Fed fund futures are pricing in. At the same time, you have that soft ADP report. If I were Chair Powell, I don't know that I would have been so explicit about taking, a March cut off the table. It's good to hear them talk about pivoting from a tightening bias to easing, but we still have a lot of data before March, and we could see softer data that would necessitate a March cut, or at least urge one. So
we certainly do have a couple of inflation reports, Ross. So I know you're going to be watching those. You're watching something else. We got this report yesterday. Q4 U.S. productivity, the estimate 2.5%, the actual 3.3%. So obviously a very big beat there. Why is that so meaningful to you?
Productivity is the secret sauce of an economy, right? It's how we produce more with the same inputs: time, money, resources. You just heard about it, year of efficiency. Some of these tech companies, boosting margins, doing a lot with a little. I think it's really important, and importantly, it's a noisy data set typically, but it's the third straight quarter of above consensus, above average productivity growth. Whether it's technology or whether it's companies just kind of buckling down in a higher rate environment and being efficient in a way that they may not have had to pre-COVID. Either way, a very good sign for the economy, a very good sign for growth in the 2020s, I think.
All right, so you're bullish on the economy, and right now you're saying that you would put money into industrials. Why is now the right time to go into industrials?
Well, they're technically sound. They've been leadership. They have some cyclical and structural tailwinds. Structural in the form of big fiscal spend coming down the pipeline, aerospace and defense spend. And then on the cyclical side, they're soft landing adjacent. So as the economy continues to remain resilient, it's been a consumer story, but we're seeing it in the manufacturing PMI. We're seeing that there's a bit of bottoming in that area. So I like industrials for cyclical reasons, secular reasons, and again, just a technically sound sector that's been leadership for a while now.